Hello, everybody, and welcome back to the Patient First podcast. I'm your host, Dr. Bryan Laskin. And as always, I'm super excited that you're here, and I'm excited for the information we're bringing you today. We have a phenomenal guest, Matt Ornstein, who's the co-founder and co-CEO of Dental Pitch Brokerage, representing sellers of dental practices to help get them sold. Matt owns Oak Dental Partners, a DSO with 65 locations, and is author of the Dental EBITDA Handbook. And you can find out more at dentalpitchbrokerage.com. Matt, thanks so much for being on the podcast.
My pleasure, Brian. Thank you for having me.
Of course. Yeah. We don't know each other well, but I was excited to have you on the podcast because when we met, you just seemed like a very positive force in dentistry. And even more rare than having such a positive force in dentistry, a positive force surrounding the accounting of dentistry. That's like you are, my friend, are like a unicorn in the industry. So I guess I'll start off just asking you, like, how did you find yourself in this position of giving financial advice in dentistry from such a positive perspective? Because my friend, I don't know of anybody else that's doing that.
Yeah, great question. When I first bought Oak Dental Partners 3.5 years ago, I started going to a lot of conferences and meeting all the great people in dentistry, who, by the way, are the nicest people of any industry I've ever been involved with professionally. And the more I spoke to dentists, the more I realized most dentists do not really know what EBITDA is. They might have heard of the term, but they really didn't know what it is. And the two most important things to keep your eyes on if you own a dental practice or a dental group is EBITDA and free cash flow. So I said, you know what? I'm going to write a very short book. It's only 20 pages that explains what EBITDA is and why it's so important to understand and how it affects the value of someone's dental practice when the time comes to sell the dental practice. And I wrote it in very clear English, super easy to understand. I'm confident someone in 10th grade in high school could understand the book. And I wanted people to be able to understand it so they could manage their dental business more effectively and understand the importance of EBITDA when it comes time to sell their dental practice.
Yeah, and I'll tell you an embarrassing story from my experience with EBITDA is when I was selling my dental practices to, at the time, the fourth largest DSO. I was in a meeting with somebody and they were like, based on the size of the number of dentists and specialists, whatever, that they said, this is probably about what your EBITDA is. And I said, absolutely. And I had no idea, no clue. And I consider myself fairly business savvy. And I would met with my accountant every quarter. And basically, my accountant would just say, things look good. And it turns out it was directionally correct. And we had probably more EBITDA than I anticipated, but could have been a very big problem. And I don't think, like I said, I consider myself relatively business savvy. So I guess I would guess and that a lot of people listening don't understand. And I guess your handbook validates that most dentists not only don't know their EBITDA, but probably don't even understand what EBITDA is. Is that correct?
Yes, that is correct. And it's not their fault. There's not much business training or many business classes when you go to dental school or in medical school or in law school. So it's very common, not anybody's fault. They just weren't taught it.
Yeah, there's lots of things that I think as you go, as if you're a dentist or even running a group of practices that you might not have it, or frankly, I don't know. I think that most dentists aren't wired to really want to understand financials, right? If they could just have it presented to them. And I put myself in that category too, even though now I'm part of multiple businesses. I still, while I understand EBITDA, I don't want to be the person looking at the financials. And I think it personally, I feel like it takes a separate mindset to focus on that versus either visioning or dentistry or do you agree with that, or is that, or am I, is that an excuse for me not to pay attention to those things?
It's definitely not an excuse, but it's very important, right? If you're driving your car and you are going on a very long trip and you're not watching the fuel level or your oil level or your tire pressure level, uh, down the road, it will have a negative impact. So you want to pay
So
things you need to pay attention to, even though they're not fun to pay attention to.
so you came up with two basically financial terms that I think probably warrant a little bit of defining: EBITDA and free cash flow. Can you talk a little bit about both of those?
Yeah, I'd be happy to. And I'll be really quick and brief about it. Anyone can get my book on Amazon. You can't use the app on your phone. You have to log on to the site either on your phone, www.amazon, or on your laptop. Just look up my name. It's Matt Ornstein, Matornstein. It'll pop right up. It's $10. 100% of the proceeds go to scholarships for kids in college. But EBITDA is spelled EBITDA. And what that stands for is earnings before interest to the bank on a loan, taxes, depreciation, and amortization. And that's amortization of a loan. I'm not getting to get into the details on it, but in very simple terms, EBITDA means how much net profit did a dental practice make before you pay any interest to the bank for any loans that your dental practice has. So I'll use a really easy example. Your dental practice, you take all your collections minus all of your expenses, and you have a net profit of $200,000. But you have a big loan from the bank and you owe the bank $100,000 in interest that year. So 200,000 minus 100,000 of interest leaves you with $100,000 of real net profit. EBITDA would be 200,000. Interest to the bank's 100, so your real net profit is $100,000. EBITDA is really important because when you go to sell your dental practice, most dentists are familiar with their collections. I had $1 million in collections last year or $1.5 million in collections. And some of the buyers will look at that, but all the buyers will want to know what your EBITDA is, which is your collections minus all of your legitimate expenses. And then buyers will value a dental practice by taking your EBITDA and multiplying it by some number. So depending on where your EBITDA is, the higher your EBITDA, the higher the multiple you get. I'll give some examples. These are not completely accurate, but if a dental practice has $1 million of EBITDA, a buyer might pay 5 times the EBITDA. So 1 million times five, $5 million. If a buyer has 5 million of EBITDA, a buyer might pay 7.5 times EBITDA, which is almost $40 million. If a seller has 5 million of EBITDA, if a seller had 10 million of EBITDA, that seller might be able to get a buyer to pay 12 times the EBITDA or $120 million. So all the buyers will want to know what your EBITDA is. The buyers will have their own financial analyst determine what your EBITDA is, even if you don't know it. And that's where the buyers come up with the offer price that a buyer would offer to pay you for your dental practice. So that's why it's really important to understand EBITDA. And the next part of that equation is if your practice would sell for 7 times your EBITDA, there's only 2 ways to increase your EBITDA. You can either increase your collections or you can reduce your costs. So for every dollar that you can save in expenses by reducing your costs, will actually get you $7 of additional profit when you sell your practice. So let's say you could figure out a way to save $100,000 a year on costs. When you sell your practice, that $100,000 of cost savings would put an extra $700,000 of profit into your pocket above what you normally would have gotten in your practice. The other way is to increase your collections. Most dental offices, this is an approximation, for every dollar in collections, a dental office after all expenses will keep a net 20 cents. So you can either increase your collections $5 to net you $1 to increase your EBITDA by $1, or you can just reduce a cost by $1. But either one of those would increase your EBITDA. And every dollar your EBITDA goes up, when you sell your practice, you're going to get somewhere between $5 and $10 extra in the sales price, which is very meaningful.
That's great information. I'd like to add though, my bias a little bit on top of this
Sure.
because having grown, so my dental practices, I practiced dentistry day to day for about 20 years and never had a year we didn't have at least 25% growth year over year for 20 years. That's a lot of growth. And then I sold my dental practices to this group and the target was 2% growth and did not make that target, by the way. And it's not, I don't know if we've ever had 2% growth since I sold it. And now the EBITDA growth probably has been there because there's been costs cutting. And so I just a little bit of a caveat where because depending on the life cycle of where you are in your growing your practices, I don't believe that you can cut your way to growth, right? That you can definitely cut your way to valuation growth, like you're saying, through and profitability by cutting expenses. However, everything, if you're going to be growing, that takes an investment, right? And so if you take that dollar of collections you invested and you have that 20% return, but you're putting it towards something that's going over time to be giving you many dollars back, that's an important sort of like asterisk to place on what you stated. Would you agree with that?
I would agree with that. Money put into growth would be credited back to your EBITDA when you go to sell because it's money that would not have to be expended by the buyer. You
Great
are
point.
correct. You are correct in saying you can't cut your way to growth. But I'll just use an example from my DSO. We invest a lot of money to grow. We grow through acquisitions and buying other practices. And we do about 100 million in collections a year, but we renegotiated our credit card fees and found a new credit card vendor, which saved us $300,000 a year with no change in patient care or any negative effect on our corporate office. So that money those savings did not impede our ability to grow. So we cut costs that had no negative effect on our growth. And as an aside, our DSO would probably sell at 12 times EBITDA. So making that little change, which saved us $300,000 a year, when I sell the DSO, 300,000 times 12, that's going to put an extra $3,600,000 of profit back to us, plus the 300,000 we're saving each year. But I agree with you.
Yeah,
You can't cut your way to growth. But if you can find things, if you can find a different formulary to use, you might be overstaffed, right? Maybe provide a little bit more training to one of the employees. So instead of needing two full-time employees to do one particular job, one of them could be trained to be more efficient and more knowledgeable. And you can only have one employee. And now you just saved 50, 60, $70,000 in costs without affecting patient care or the growth of your dental offices.
yeah, and I think right now most dental practices that I talk to are starving for employees, and so you may not even be able to find that extra employee. So if you can do something like automate through technology for something that costs 100 or $200 a month versus hiring another employee, that's hard to find. It's like your example of credit card processing, which is a true no brainer, right? It's just going to increase your EBITDA month after month, year over year.
Correct. Yeah, and I'm a big fan of AI and technology to reduce costs and increase efficiencies and productivities. Yeah. Is it okay if I talk real quickly about free cash flow?
Of course, I'd love you to talk about free cash flow.
So everyone talks about EBITDA, and if your EBITDA is negative, you're in big trouble. You're probably going out of business. But there can be instances where you have positive EBITDA and you're losing money. So how does that happen? So let's just pick an easy number. Someone has $1 million of EBITDA at their dental practice, and then they have no debt, so they don't owe any interest. So their net profit is $1 million of EBITDA minus zero interest payments to the bank equals $1 million. So that dental practice has $1 million of net profit. But sometimes you could have a dental practice with $1 million of EBITDA, and you could actually owe the bank a million or dollars in interest a year. So after you pay the interest, even though you have a million of EBITDA, you have zero cash left in the bank. And cash left in the bank is called free cash flow. It's cash that's free to use for whatever you want. And the worst situation you can get in is if you have a million, this is an example, $1 million of EBITDA, and you owe the bank $1,200,000 a year in interest. Now you don't even have enough money to pay the interest on your bank loan, and you're in big trouble. So EBITDA is important to watch. Obviously, you want to maintain your EBITDA or try to grow your EBITDA if you're a dentist, but you have to watch your free cash flow, because you have to have positive free cash flow after you make any interest payments on any loans you have, or you're not going to be able to make payroll. You're not going to be able to pay your lease for your building, equipment leases, et cetera. So you've got to keep your eye on EBITDA and make sure you have positive free cash flow.
So you left out one important letter from my perspective in my history in EBITDA that affects cash flow, and that's taxes. Because in my experience, it's like my accounting firm is the magic box that the numbers go in, and then way too late, a number comes back, and I'm like shocked by how much I owe in taxes. So how could you talk a little bit of how you can, because interest that you owe to the bank is probably pretty predictable, but in my experience, maybe it's because my lack of financial knowledge, and is the tax seems like the account almost rolls the dice, and then that's what I end up paying at the end of the year. So how do you address the tax in EBITDA and how that affects your free cash flow?
EBITDA is earnings before interest and taxes. So it's the number, the profit before you pay interest to the bank and before you pay income taxes. So regardless of whether you owe interest or you don't, or how much interest you owe, or how much you owe in taxes, your EBITDA number would be the same. If you have positive free cash flow, you're going to have enough money to pay income taxes because interest is deductible. So I'll just use an example. You had 2 million, let's say someone has 2 million in EBITDA. That dentist owes $1 million in interest to the bank. So 2 million minus 1 million still leaves $1 million. The interest is tax deductible. So the taxable income in that example, that dentist would have a taxable income of $1 million. If the dentist owes 35% in taxes, you can take that $350,000 out of that $1 million. Where you get into big trouble is, like I said, if your interest cost exceeds your EBITDA and you take all of your free cash flow to pay interest to the bank, you'd have a loss, so you wouldn't owe any income taxes. As long as you have positive free cash flow, which is your true net income, you're going to have money to pay your income taxes, which is never, obviously, no one enjoys that, because any entrepreneur and business owner could take the money that they don't have to pay in taxes legitimately and then use that to grow their practice and reinvest in their own business. But if you have positive net income, you'll have enough money to pay your income taxes, provided you didn't spend all of it before the tax bill comes due. Great question.
Great information, and it's just valuable service that you're offering up for all the dentists that are listening, and basically people that are running DSOs too, because my guess is that even the people in DSOs at whatever level they're at, unless they're directly engaged with the financial aspects of the business, would benefit from the information you've delivered. So to get more information, to order the book, go to Amazon.com and search Matt Ornstein, Ornstein. And to find out more, go to dentalpitchbrokerage.com. Matt, thanks so much for being on the podcast.
Thanks, Bryan. It was a pleasure. Hope you have a great day.